Let's drill into the inflation rate. It slowed slightly to 2.3% last month. The economists had thought it would hold steady at 2.4%. And it's interesting as well because a year ago, the federal government had cut GST rates, and that brought down the price for booze and restaurants. Of course, that cut no longer in effect. So that has tended to push up prices, for example, for restaurants. Still, inflation coming in slightly lower than expectations. Let's get more from Dominique Lapointe, Director of Macro Strategy at Manulife Investment Management. Dominique, thank you very much indeed for joining us.
Good morning.
What do you think? Was there any surprise, anything jump out for you with these inflation numbers?
I think it's a very good report overall. If it wasn't for last year's tax break that you've just mentioned, I think we would be very close or at 2% on the headline CPI target. And what we see is it's been around 3 months that we really struggled to find inflationary pressure in Canada. And that's also consistent with what we see elsewhere in the economy. Wage growth isn't very strong, and companies are saying they're not intending to raise wages a lot this year. And at the same time, overall, there isn't a lot of economic growth, like we already know. Mm-hmm. So it's consistent that we see those kinds of weaker inflation report, and that's probably a good news for policymakers in the Bank of Canada.
And I think you talked about companies and their propensity to increase prices. Do companies feel they can get away with it right now, generally speaking?
I mean, I think it's been documented that some of the past ability for companies to raise prices when input prices were up and they had the ability to do so is sustained. And so when their input prices are coming down, they're not really quick on lowering prices, mm-hmm. especially at the retail level. But at the moment, they don't have a lot of ability to pass on those input costs, and at the same time, they would report that their input costs are not growing as fast as they did. So I don't think that's the biggest issue at the moment.
Mm-hmm. You say that the central bank does, you touched on this, disinflationary forces right now. Tiff Macklem and his colleagues are seeing those, including slowing wage growth. Are we at any risk of moving towards deflation, Dominique, at this stage?
Yes, so deflation, outright deflation is still very, very far overall. Mm-hmm. So like we mentioned, inflation is still around 2.3%. Core measures, the one that would strip out the volatile items, depending on how you look, they could be a bit above 2%, but on a momentum basis, when we look at, let's say, the last 3 months, they're slightly below target, around 1.7%. But then again, you're very, very far from the deflation. Where we could see deflation, though, is in shelter, which is a surprise, and it hasn't been that for many, many years in Canada, where you have mortgage interest costs that are slowing because mortgage rates are lower than a year ago. You have home prices that are either slowing or falling, depending on which cities you're in. Mm-hmm. And rental prices also falling in Canada, which is a rare occasion. And that has impact on other adjacent categories like insurance, so slower inflation there, and even repair. So that's another good news for consumers.
That's interesting. Rental weakness. I'm not sure if you have a handle on this. Is that a national thing, or would it be very much driven by Toronto with our huge surplus of condos?
Depends on the market. It's again very heavily tilted by Toronto and Vancouver because many units that were built for condo purposes are now either redirected towards the rental market because you didn't sold them, you're putting them on the rental market. Mm-hmm. But in other markets where rents are controlled, like Montreal, there is somewhat of a slowdown too. So it's both a national story, but also a city-by-city story. And again, there's still some very tight spot in the rental market. Rents are high compared to where incomes are. But the big story is that it's slowing.
Bank of Canada, you think it's highly unlikely they'd be inclined to increase rates this year?
Yes. And the reason why we do mention this to our clients is because after the December labor force survey, which showed very strong jobs growth, the markets started to incorporate the possibility that the Bank of Canada would hike one time, even more than once this year. We know that some of my colleagues are anticipating that there will be rate hikes. We're not of this view for three reasons. The first one is inflation, like this morning, doesn't seem to be a big concern. Economic growth isn't very strong, so it's hard to envision that strong growth now will lead to more inflation through wages. Mm-hmm. And at the same time, the biggest reason why it's hard to move at all from the Bank of Canada, both on the cuts and on the hike side, is the uncertainty with mm-hmm. the current trade uncertainty and upcoming trade uncertainty with the USMCA renewal process.
So do you think Tiff Macklem will just be inclined to do nothing for now, masterful inactivity?
That's what we think. That's what we've been thinking since October. Actually, the way that they view rates right now is that it's slightly below neutral, just a little bit. So that's providing a little bit of boost to the economy, and we sort of see it through some of the consumption measures they're holding on. We think that the housing market by the middle of this year will pick up a little bit. But that's not enough to think that we're going to get a big boost. But again, there's a lot of uncertainty about that. If we get a deal with the U.S., then maybe business investment picks up, and then there's a scope from some slight firming. But until we see that, it's hard for anyone to predict. We think that the Bank of Canada will be on hold, and they're going to signal that they're going to stay on hold.
Dominique, thank you very much indeed. Really appreciate it.
Thank you.
Dominique Lapointe, Director of Macro Strategy at Manulife Investment Management.